Hey everyone, welcome to the back channel. Today I want to talk about a really scary thing in the world of venture capital today. That thing is the pre-seed round. I recently sent out a post on all my social media accounts that said, do you know what the scariest round for a venture capitalist to invest in today is? It's the pre-seed round. Now, that caused a bit of a stir, some conversation, so I wanted to record an episode that had a bit of an overview of why I think that is. So taking a couple steps back, let's talk about the pre-seed round. So the pre-seed round was a relatively newly invented, quote unquote, round. Essentially, it sprung up, call it 5 to 10 years ago, as investors figured out that there was more and more competition at the seed and Series A levels. So as more and more money started flowing in to this space from LPs who wanted to get exposure to the great investment opportunities that early stage technology offered, the more money that was coming in, the more people realized that there was too much competition, and they found out they had to go earlier and earlier in order to catch deals before they got to a very competitive level at the seed and Series A. Now, as people started squeezing money in earlier, and as capital became cheaper, especially in the ZERP area where people had money, they wanted to deploy it, so they would just start throwing money at founders who had less and less traction, less and less proof points, all the way to seeing $1 to $3 million pre-seed rounds, sometimes even more, for founders who had very little to show. Now, as the market started correcting, as we started seeing things like Silicon Valley banks collapse, and as LPs began to be a little bit more hesitant of backing GPs or venture capitalists that would put money into very risky bets, we started seeing venture capitalists lose their risk appetite. Now you started seeing VCs talk about founders getting to profitability, break even, much sooner than they used to. It used to be all about blitz scaling, spending money for growth, and then finally turning on revenue and profits much, much later. Today, we are at a different place. In a different segment, in a different episode, in a different essay, I'll probably talk about how I believe that venture capital has overcorrected. It's no longer funding big shots and big opportunities that require investment upfront. It's now become, at least right now, a space where venture capitalists only want to bet on things that they feel really safe about. I think that will change in the future. But for now, let's get back to it. This means that the pre-seed round is one of the scariest rounds for venture capitalists to invest in. Like many of you, my last venture-backed startup was a SaaS business. In that company early on, we had the opportunity to sell into a large enterprise, but ran into some walls when they asked us if we were SOC 2 certified. Not only were we not certified, we also found out that it would take our small team a ton of time to get that done, and so we ended up abandoning the deal. If you haven't run into a situation like that where a potential customer or investor is asking if you're SOC 2, HIPAA, GDPR, or ISO 27001 certified, you probably will soon. But unlike me, you could use a company called Vanta to help. Vanta helps automate up to 90% of the compliance work, getting you audit ready in weeks rather than months, and eliminating up to 85% of the costs. Not only that, but Vanta can start small with you and scale up as you grow, helping you land bigger deals and earn customer trust. The best part is, Vanta is offering funded listeners $1,000 off for going to vanta.com/funded. That's VANTA.com/funded for $1,000 off your service. Check it out. They don't like seeing founders who don't have any proof points. And by proof points, we don't mean just product. We also mean proof of customers, which means revenue. So what does this mean for founders who are starting companies today? It used to be that you could raise a little bit of money, maybe $100,000, $200,000 from angels, friends and family, incorporate, get going, try to recruit a team, and then go out and raise a pre-seed round and say, we're going to go build a product. Or if you had a light proof of concept, a light MVP, you're going to be like, we're going to raise this $2 million pre-seed to build out the product, get initial revenue, and then go raise your seed round. Now it looks like seed investors require something like $250,000 of annual revenue or something similar, depending on your business model, in order to get excited. But everything before that, it doesn't look like investors are getting excited to fund, which means you're stuck in a very difficult place where founders who need to build product in order to get it to customers are trying to figure out ways to get to that mark so that seed investors will back them, so that pre-seed investors will back them. What I'm seeing is that pre-seed investors really are not backing pre-product companies, and shreds of revenue aren't enough. They need to see acceleration toward that seed round. And so there's a very narrow band. So what I'm actually telling founders now is you should try to go raise a larger friends and family angel round, push into that so that you can use that round to get as far as you can into revenue. That means being way more capital efficient. That means pushing sales early on. It means that these earliest stages of especially enterprise SaaS companies are much more difficult, but I think in the long run, it'll create better companies. So it's a bit of a winding way to describe this challenge around pre-seed at the moment, but I think you guys can get it done. And reach out if you have any other questions. I'd love to hear from you. So thanks for listening to this episode of the Back Channel. I hope you get through that pre-seed squeeze.